3, 2, 1. Welcome to the show, everybody.
Welcome to the show, indeed.
It's a beautiful Friday in Northern Virginia.
Man, what a week.
Yeah, I know.
What a week. Okay.
Oh, you mean the market?
Yeah, I get kind of fixated, and so this week kind of brought me down a little bit.
Yeah.
But, I spent half of last night looking at all different analysts' perspective of what has been going on in the past 2 weeks. And some of the stuff I put out in the Facebook group over the course of this week.
Mm-hmm.
I'm pretty sure I put out David Keller's podcast about, I think it said look out below because we had broken that 4,200 level. That was a big level. So him and Katie, can't remember her last name, the one analyst we've been looking at the last couple of weeks. I mean, a lot of people are looking at that 4,200 level like it was really, really important, and we'll show it on the weekly chart at the end here. But
it is really important.
It is, yeah, it is, and that's why it was our line in the sand, basically.
Yeah.
I got a really interesting comment from the market update that we put out last night. That was referring back to the members only call the last one that we did, and we had this ABC correction down, it was definitely, you could see this correction taking shape and where the bottom could be. But once we broke below that 4,200 level, man, all bets were off. And then for it to flip back around like that has caught, everybody off guard.
Yeah, but what sucks for those of us that are, it sucks for all of us, right? As we're watching this, is we get caught up in the day to day, right? And the hardest thing to do in all of this, and this is where I try to go back to every time this happens, right? Where it doesn't go the way we think it's going to do.
Yeah.
Well, we don't have a crystal ball. We don't know, right? I just keep reminding myself that, we're trying to manage our retirement funds, right? And that is a 30-year program, right? Yep. That is not a 2-week program or a 2-day program. And, Fed comes out and says a few things and everything goes the opposite way. And there's no way to guess any of this stuff, right? And so to keep it in perspective, the real perspective is you can't time the market that way. And it's not timing the market. It's so much as like with our restrictions,
right?
It is what it is. Like we can only move twice a month, and we have to be very, very strategic. And when we do that,
right? If
we could just jump in and out willy nilly, no big deal. But that's not how it works.
No, it's not.
Yeah.
All right, let's
do it.
Let's do it. So, this week's events. So I just wanted to. There's a lot of stuff to talk about, but I just wanted to kind of talk about these three real quick. So we have the Fed meeting this week. Fed comes out, and we're watching it on Bloomberg, and they keep rates the same, right? And 98% of analysts expected Fed was going to hold rates where they were. Then in the press conference afterwards, Powell couldn't have been more hawkish. He's like, yes.
And that's literally the word that every analyst I saw, I kept switching back and forth between talking heads.
Yeah.
Everybody said that word. They were like, he was so hawkish.
Oh, it was so blatant. Every time somebody asked him a question, he's like, "Oh no, rates are staying higher, and they might even go higher."
Right.
And
nobody was hearing it.
Nobody believes it.
No.
Right? So nobody believed him, and so the market jumps on his announcement, and it kept on going. So then we have Apple earnings. We had a whole bunch of important earnings this week, but Apple was a big one. So last night, Thursday night, Thursday after the close, Apple comes out with earnings, and they're bad. Forward guidance is bad. Apple is the biggest component in the S&P 500, and it was down 3.5% in after-hours trading after earnings came up. And so earnings are an important piece. And this earnings season has not been great. Some areas have been good, but some not. Apple down like that on any normal day would have pushed the market way down. That's not what happened today because because of the dollar and yield. And we've been talking about the dollar and the 10-year yield for a long time. And I'm going to look at those two charts again today. We're going to do a really deep dive on what's going on with yield in the newsletter this weekend because it has the most impact on the F fund. Okay, and then the jobs report comes out Friday morning, this morning at 8:30. This is the most amazing thing. Last jobs report, so for September, the economy gains 300,000 new jobs, and everybody is worried that that's inflationary and all that. Today's job report comes out. Unemployment goes up to 3.9%. There's only 150,000 new jobs added, which is less than analysts expected. Everybody's talking about how, it's pretty clear now that the economy is starting to contract and things are going to get worse and all that. And what happens? The market explodes to the upside because that means that the Fed now is going to be as hawkish as Powell was 2 days ago.
They're going to be thinking about.
It's going to be hard for them to push rates up any further. So since they can't push rates up further, and rates fell, we're going to get to rates fell like a rock. So they can't push rates up any further. The economy's getting worse. Nothing has broken yet. The soft landing scenario is that rates come down, nothing breaks in the economy. Unemployment, say it's at 3.9% now. Say it only goes up to 4% and kind of stays around there, maybe comes down a little bit. That's the absolute best case scenario that we can possibly have. And hopefully that's what happens. And the stock market is definitely factoring that in. But it amazes me that on the one hand, they're obviously acknowledging that the economy is rolling over, and you would think that would ultimately be reflected in stock prices moving lower.
Right.
But the short term of that is that means that the Fed can't raise and might lower, and therefore stocks prices go up. So we got bond prices going up because yield is going down. So bond prices are going up and stock prices are going up. That is not going to work in the long term. It is just not going to work.
But again, it's we use this. We talk about perspective all the time, right? And we're sitting here talking about. I mean, what's it up in the last 2 days? Is it 3%?
At least.
Yeah.
I mean, this week is going to be up like 4%. Yeah.
Right. But what we're looking at is a potential downside of 20, 30. Sure. We don't know that we don't because the line in the sand on the bottom is way down there, right? So again, perspective. We're talking about this little wiggle here, where what we really should be talking about, and what everybody is talking about, the analysts are talking about, is this looming drop of this. And sure, it'd be nice to get 4% this week, and that'd be great if all things were if it was possible. But sometimes it's just not. What we really should be worrying about, or focused on, not worried, but focused on, is our ability to not take that that looming drop. That it's not just us saying that.
Oh no,
right?
No, it's looming.
It's pretty much every analyst, bearish, bullish. They're all saying, man, that 4,200 line was a kicker, and so market sentiment for a week, because all these other little things that are happening, right? Those are micro issues, right? The bigger issue is you don't want to be in when this thing crashes.
Yeah, 100%.
I mean, that's our focus, really. I mean, we've always been pretty upfront about that. Right.
I mean, because you're right. It's if you are retired or close to retirement, and you're looking at that 4%, this week in relation to your larger portfolio, the risk
is massive.
To the downside is much bigger than the potential upside gain.
And if you think you're going to be able to just willy-nilly get in and out and get 4%, I mean it would be great to have gotten that 4%.
Oh yeah.
But not at the risk of losing 20%. That's the perspective that people have to get their head wrapped around. And I mean, it is, you either get it or you don't.
Yeah.
And we keep saying it out loud until people get it, and they'll either get it or they won't.
Yeah. Well, we'll see. I mean, we'll see. Anyway, I had to call a couple of audibles on this, but I am going to go back to this Wall Street Journal article to go through that kind of quick because it was really interesting article this week. Would have posted it in the Facebook group, but seeing as how most people don't have a subscription to the Wall Street Journal, they wouldn't be able to read it. So I'm going to kind of go through it here. And then we'll look at a chart of the dollar, 10-year yield, and then the C fund. So kind of to the point of what we're just talking about, your set it and forget it 401k made you rich, no more. Stock and bond portfolios that worked for the past 40 years aren't ready for what's coming. So we're not in Kansas anymore. For 4 decades, patient savers able to grit their teeth through bubbles, crashes, political upheaval won the money game. And as we've been talking about for a long time, the reason they say for 4 decades is because interest rates have been consistently dropping since the top in 1981. By the formula of building a nest egg by rebalancing a standard mix of stocks and bonds isn't going to work nearly as well as it has. Now long-term yields hit their highest level in 16 years, causing the value to plummet, and stocks are expensive. So investors need to lower their expectations and play defense. That's exactly what we were just talking about. Summer of 2020 was the point when the classic set it and forget it stock and bond portfolio was as good as it got. Investors who didn't panic early that year when COVID-19 crushed stocks cheered how quickly the quickest return to a bull market in history. Likewise, long treasury yields plunged to a record low, bolstering bond funds. A classic 60-40 stock bond split. Owning that proportion of the S&P index and 10-year treasury notes earned a respectable 15.3% in 2020, but there are a few free lunches in finance. So squeezing out those impressive returns out of a worldwide economic calamity added to the U.S. government's already considerable bill after the global financial crisis. Federal debt held by the public mushroomed from less than $5 trillion in mid-2007 to more than $21 trillion in 2020. That is unbelievable. So federal debt has quadrupled plus since 2007. So meanwhile, overnight interest rates are pushed down basically to zero from about 2009, where they stayed until early 2022. So you got basically zero. It was 0.5%. So basically 0% interest rates for about over 10 years. By last year, the massive budget deficits and 0% interest rates shocked the highest inflation in 40 years, forced the Fed to play catch up through a series of rate increases. I don't want to keep reading through all this. So an investor who put let me just go to this. An investor who put $1,000 in a 60-40 portfolio at the end of 1981. So this was the top in yield, right? So if you put $1,000 in a 60-40 portfolio in 1981, even after adjusting for inflation, you had $18,700 by the end of 2020. So it was easy for anybody to make money from 1981 to 2020. Okay, that portfolio would have lost money only in 5 of those years. So it's no wonder why even the pros on Wall Street treat the classic balanced portfolio like it's gospel, right? Buy and hold, 60-40, ride the market ups and downs. Ever since 1981, you would have done really well in that scenario. You have to have been working for more than 43 years therefore you'd be over 65 years old to have seen a prolonged period that was other than this, right? An earlier generation had a completely different experience. In the mid-1960s, stock valuations were at their most expensive level in decades. And at the same time, inflation had just begun to take off, okay? So as a result, back in the 60s, I'm going to show a quick chart on that in a minute, a family setting aside $1,000 for their toddler's education in 65 in a 60-40 portfolio only had $785 by 1982. Okay? So while you had giant gains from 81 to 2020, you would have had in real terms, a loss from 1965 to 1982. And they're saying things aren't looking much better today, right? It's pretty similar. Last year was one of the worst ever in real terms for the 60/40 portfolio, and the beatings continue. Shiller's valuation metric is still higher than it was in 1966. So here's what they're talking about on that chart. This line is 1982 to 2020, right? People made a killing. If you had $1,000 invested in a 60/40 portfolio, you did really well from 1982 to 2020. But from 1966 to 1981, that $1,000 went flat to down over that time period. So there are definitely times when the market always goes up. That mentality works. Buy the dip, buy and hold, all that. There are other times when that mentality does not work. And if we are in this kind of, circumstances right now, the buy and hold methodology will not work going forward. And that's the baseline of this article. Okay. So investors can prepare by lowering their return expectations and playing defense. Ironically, the traditionally risky part of the 60/40 portfolio could be safer, relatively speaking. They're saying, I'm going to kind of take issue with this on the next chart, but ironically, the traditional risky part of the 60/40 portfolio could be safer. That means the stock piece, the 60% piece of this, he's saying could be safer, relatively speaking. Stocks cratered in the inflationary 70s, but they're more resilient to inflation than bonds. And investors don't have to just buy the pricey S&P 500, which is dominated by the Magnificent Seven tech stocks. Small caps, emerging markets, and value stocks offer the benefit of diversification at what seems like much cheaper prices, which is true. The S fund is way undervalued versus the C fund right now. The next decade might not be pretty, but with work, it can be less ugly. And you can check out whatever Spencer Jacob writes at the Wall Street Journal. But this is the chart I was talking about. I'm not on board with the last part of what he said. This is the C fund. This is the F fund. So the C fund, all-time high here in January 2022. F fund at an all-time high back here it was back here in 2020. F fund is it's hard to see the proportion on this chart, but it's at an absolute historic low right now. We're going to have 3 consecutive down years for the F fund. It's never happened in the history of the F fund. Stock prices are still really high. So I would kind of argue that the less risky place to be is in the bond funds, because when yield falls, bonds go up. When yield falls, stocks can go up, which they have done this week, but a lot of times when yield is falling, it's because investors are fleeing to bonds out of stocks, and so stocks come down. So it's going to be very interesting to see going forward which of these plays out. Yes, stocks do better over time relative to inflation, but right now it looks to me bonds are, from a value perspective, a much better place to be. Okay, the dollar. So I know we've shown this chart a bunch of times. 2022, January was a low in the dollar. When the dollar goes up, stock funds go down, right? Dollar peaks in October. That was when stock funds were at a low. The dollar has been running up since July. If you remember, July was the peak in the S&P 500, and it's been going down since then. The dollar's been going up. This week, huge negative engulfing candle in the dollar. And as we should expect, stock funds go up. So if you overlay a chart of the C fund on the dollar goes up, C fund goes down. Dollar goes down, C fund goes up. Dollar goes up, C fund goes down. Big move down on the dollar is a big move up in the C fund. So following the dollar, critically important to see what happens going forward. Yield. We've been looking at this chart for a long time. It's really important in terms of the F fund because when yield goes up, the F fund goes down. Yield goes down, F fund goes up. You get a really good 1, 2, 3, 4, 5 Elliott wave. The big question was whether or not we were at the top of wave 5, and it's definitely a possibility that we are there. On a weekly basis, we hit that two weeks ago, whatever. Hit it intra-week there, and then last week hit it at the open, and this week, obviously, yield is way down. So the combination of yield being way down and the dollar being way down push stocks way up. And this is what it looks like when yield goes up, stock prices come down. Yield goes down, stock prices go up. Yield comes down, stock prices go up. So yield and the dollar are definitely the two most important things to watch in terms of stock prices. C fund. So this is last week's C fund chart. We were talking about how you got 1, 2, 3, 4, 5, 6 weeks below that 20-week moving average line, right? You can come down and hit it and get support there, and that's good. Those are all buy the dip opportunities. Once you get down here below that 20-week moving average line, you tend to stay down there for a while. Okay? We had 6 weeks below that line. And the biggest thing was this break in that 4,200 level. Last week was a huge candle down below that 4,200 level. We were talking about how this ABC correction would have been great. And we got support there for 1, 2, 3 weeks. And this would have been a great place to take off. But we didn't get that. We got a breakdown in a big way below that 4,200 line. Then you fast forward to this week, and we got this move that has engulfed the last 2 big down weeks, all of the weeks prior. So 6 weeks worth of price movement to the downside in 1 week, and we're back above the 20-week moving average line. When do we see this kind of like price movement before? Right there. This is a good one. This could be the beginning of a new rally. Or it could be a head fake like this. We don't know yet. And we were talking about how what really matters is the long-term trend. So right now we are in this down channel. If we get outside of this down channel, odds are we keep moving higher. What would be really helpful is to have some kind of a pullback that gives us a higher low, and then we take off, right? Something like some kind of consolidation at a bottom, because otherwise we get things like this, a big week up that engulfs all of this only to roll back over to new lows. So the concern right now on a week like this is that it just rolls over to new lows. So it remains to be seen what happens. But what I'm hoping for is some kind of pullback, ideally back to the 4,200 line. That would be the best. And then we take off. That's the best case scenario going forward. Because if this thing just keeps going up from here, it gets way overvalued to the upside, and then there is some kind of big pullback. So,
yeah, it's a very, very dangerous time to be in the market, right?
Yeah.
And if you had all the moves in the world, it makes it a little safer, but you don't.
No, we don't have that.
And so we are not going to take those kind of chances, with our retirement account. So, and I say that because I really want people that are listening, hopefully they're listening to us, paying attention to us, and that, it would be great if all things considered, we could have gotten this little uptick. But as Jerry just pointed out in that slide, that chart, I'm going to put it back up there. That is not a trend.
No,
right?
Certainly not one that we can trade.
Yeah, it's not a trend change. it's an uptick
Yep.
for sure. But we're hovering around a very important line right now. And the safest place to be, again, when that's happening, is in the G fund. G fund's doing fine right now.
Yeah.
No reason to pout about being in the G fund. But while you're watching this, kind of sideways movement, that's a safe place to sit and watch it. If you're in right now, great. And if you got the gains from the last couple of weeks, but you better be watching like a hawk.
At the end of the day, that this is a very dangerous market all the way around.
Yeah.
And the downside risk is significant. Potential upside, I mean, yeah, it's there, but if I think.
But most people are not pointing to that. That's the problem, right? I mean, we can be optimistic all we want to, right? And I'm usually the optimistic guy, but when you look at that chart, all you see is a lot of room to go down.
Yep.
A lot.
I mean, even the guys that are really bullish, like if you're well, like last weekend's newsletter, we did a comparison between the Elliott Wave guys and the Stock Traders Almanac guys, and Stock Traders Almanac is a seasonally based publication, and so we are in now the most bullish time for stocks, and a lot of people are going to point to
according to seasonality.
According to seasonality, right? So people will say, "See, seasonality says the market's going up and it's going up," and yeah, I mean it did. So you can't.
It very well could be, but that's not a trend change yet.
Not yet. No, not yet. We'll see how it goes. It's a very difficult time to be in the market and very dangerous, no doubt about it.
Yeah, just pay attention. That's really the takeaway I want for most folks is pay attention.
Yep.
If you want any more, in-depth analysis, as we've been talking about throughout the podcast, and you guys hear us talk about things like market updates and newsletters, those are things that our subscribers get. Last night, was it last night?
Yep.
It's been a heck of a week. Last night or yesterday, late yesterday afternoon, we put out a market update, right? And we do things like market updates when something significant happens in the market that we feel like we don't want to wait until we do the Sunday newsletter. Right. But every Sunday, we basically take a look at the whole week, what we see coming forward, all those things. Jerry breaks down a lot of, other folks' analysis, our analysis, and, the idea is that we want to give you a big enough picture, right, that you can make decisions about your account. And if you're sitting there wringing your hands, looking at the market this week, in the past few days, don't stress over it, right? This is a long game. Take a step back, look at the big picture. If you have questions, send them to us. We have, anywhere you find this video, you can put questions in the comments section. If there is no comment section, or if you just want to shoot us an email, support@growmytsp.com. The support team gets them over to us, relatively quickly.
Yep.
And we'll get it figured out.
All right.
All right, guys. Have a great week, and we will see you next time.
Later.
Much later?
Not too much later. Next week.
Just next week. That's kind of loud.